inside of that tax bill, one of the key provisions is 100% bonus depreciation being, I think it's going through 2025. So it would be retroactive to 2023. It would be 100% in 2024, and then also 100% in 2025. I believe I have that right. What that means, so without this, if this doesn't get passed, then bonus depreciation actually started phasing out in 2023. So it used to be 100%, but then in 2023 it was 80%. 2024, this year it's 60%, and then it goes to 40, then 20, then 0 in 2027. If this bill passes, retroactive to 2023, 100%, and then pushing off that phase out.
Hey guys, it's Brad. Welcome back to the Probate House Guy podcast. I am the Probate House Guy, and today we're going to get in the weeds about taxes, a topic that some people might find boring and other people might find exciting. But in the real estate space, a lot of us do this for the tax reasons. And I'm here with my CPA, Brandon Hall. You have been my CPA for many, many years. You run a fantastic firm. You have a great team of people. I love you guys. You've been awesome for, gosh, how many years now? So tell us a little bit about yourself, Brandon.
Yeah, I appreciate the positive endorsement there. Thanks, Brad, for having me on. My name is Brandon. I'm a CPA. I started the firm back in technically 2015, but I think I only netted like $4K that year. So I kind of tell people 2016. So I went full time into it 2016, Q3 of 2016. I was on the Bigger Pockets podcast, and the rest was history.
Yep.
Yeah. So it was awesome. But today we have we were just talking before. We've got about 55 people, a team of 55 in the U.S. We're 100% remote, and then we've got another 35 or so on our global team. So it's become a pretty big operation. But yeah, we service real estate investors, tax planning, tax compliance, like preparation. And then monthly accounting services. We've started to get a lot of those clients, especially in like the syndication and the fund world, where sponsors really need to offload that function. So that's kind of where we're at. But it's been a blast. All of our clients invest in real estate, and that's it's been a unique thing. And I think it's unique for the size of firm that we are as well at this point. But we've stayed true to our niche.
That's great. And you know what? Like early on when I first got into the real estate investing world, everyone was like, you need to find a CPA who like only does real estate stuff, because there's so many like very niche topics, and we'll get into some of those today in the real estate space, that like only a real estate expert kind of knows these, and maybe the other guy down the road that does taxes for like everybody in your county, maybe he kind of knows these things, but like that's not his forte. So it's better to have somebody who's like really, really specialized in your niche, in your space.
Yeah, I mean, still agree with that today. And I know that probably sounds a little self-serving, but a good example is the person that's not touching real estate every single day. They're going to mess up the passive activity loss rules. They're going to mess up your carry forwards. We see it all the time. So, and that's before you even get into like real estate professional status and the short-term rental loophole and all the crazy stuff that you hear about online that you can do. So yeah, I think that if you're investing in real estate, you need to have an accounting firm that specializes in real estate. Now, the interesting thing, I've actually started like helping some other CPA firms learn how to scale their firms. And one of them asked me recently, was like, well, are you niched in real estate? And I was like, well, yeah, I'm niched in real estate. Of course, that's what we are. You know that. They're like, but you don't do any other businesses. You only do real estate. And I was like, oh, interesting. No, we do a ton of businesses. Like we got like business. We have like vineyards and manufacturing companies and car washes. And we have like tons of different businesses that we do. But I never thought about it like that. I was like, oh, we're really real estate first.
Yeah.
And you can do whatever you want else, and we'll handle everything, but we're real estate first. And I think that it made me think about the whole like niche thing. Do you need a specialist in real estate? And I think that the point that I'm trying to make is you do need a real estate specialist when you're investing in real estate, and you can kind of bring the other business stuff along, because quite frankly, that other business stuff is going to be less complex than navigating Section 469, which is the passive activity loss rules. So my suggestion, like real estate adds a lot of complexity, even when you have only one rental. So I would start looking for a real estate specialist. And the interesting thing that I didn't realize would happen at my firm is as we've scaled, we've grown this big team, we've attracted like really smart people. Once you hit a certain size of scale in a CPA firm, you start attracting like really, really, really smart people that you're no longer viewed as risky to come work for, basically. Mm-hmm. Accountants don't like risk. So they come over and they start playing ball, and you just like, you all of a sudden you're able to do way more than I ever could have done with a team of 5 where I had to be the subject matter expert. Now I can just bring in these various subject matter experts and they all like bounce questions off of each other all day. That's like, we have this huge knowledge base built out. So it's been cool because our capabilities as we've grown have become tremendous. But anyway, circling back to your point, yes, work with a real estate specialist and then consider that size too. The larger firms will typically have more resources at their disposal. Doesn't mean that you should necessarily go that route, but it's something to consider.
Yeah, I agree with you there. In fact, you guys have a like a mailbox. I'm not going to say it on here, but like for your clients where we can ask questions. Yep. And it's generally never the same person who asks the questions. I may throw out a question about one thing or another. Hey, if I do this, it's like kind of falls outside of like the advisement space, but it's like a quick question about like, hey, I'm about to do this thing. Like, should I do this or this? You know, like, and you guys have that. And I've noticed over the years, because I mean, I remember my first year with you did my taxes, right? But now you have people that do it for you. You built out a fantastic team. And with that team, like you said, comes with all the expertise. So like you can just throw that out there and you'll get an answer back. It's almost like I've had that legal shield thing for years and years. And if I have some random weird legal question, I just like email that box and one of their attorneys responds and says, hey, do this, right? Yeah. And it's cool. I like that. I like that having that wealth of knowledge to tap into for sure.
Yeah. We try to come up with different ways to serve clients. So we've got various levels of service that you can opt into, but that's all. I think you're referring to TaxSmart Insiders, or like kind of private online forum.
It's your general like mail. Your general.
Oh, you're just okay. Yeah.
It's your general. Like I've thrown some random questions. Hey, I'm about to do this with my LLC. Should I do like this or this? And you guys were like, oh, do it this way, or hey, it doesn't matter. Do it either way, whatever you want. You know. Because I don't want to like create some crazy taxable event by someone might be going rogue, right?
No, we appreciate you asking those questions. We wish more people would ask the questions proactively rather than get surprised in January. So,
yeah. Actually, I remember one of them. It was like back in during COVID, and the government was like, "Hey, you can withdraw money from 401k and not pay the penalty." And I was like, "Hey, I'm kind of intrigued by it because my wife has a 401k from her job." It's like, and we were about to start building our house at the time. It's like, can I take some money out of that? Like, do you advise whether I should or shouldn't do that? You know? And I got a good answer from you guys. So, appreciate that. So, let's talk about tax strategies, on the horizon for 2024. There's been some talk. I've just actually got an email earlier about something going through Congress right now. So what are kind of some new tax strategies, or maybe some old stuff or whatever that's kind of on the horizon for 2024?
So not so much new, but definitely popular is the tax bill that you just referenced that is sitting in Congress right now. It's sitting in the Senate. We don't really know when it's going to get passed. We were all kind of hoping it would be passed by now because we're all sitting on a bunch of tax returns that we can't file until this thing gets passed.
Right.
And now the IRS is saying, go ahead and file your tax returns and we'll true it up later. But it's like, do you really trust them to true up your bonus depreciation? I don't think so.
No.
So we're sitting on a bunch of tax returns right now, just crossing our fingers that this thing's going to get passed sometime within the next couple of weeks. But inside of that tax bill, one of the key provisions is 100% bonus depreciation being, I think it's going through 2025. So it would be retroactive to 2023. It would be 100% in 2024, and then also 100% in 2025. I believe I have that right. I think I have that right. So what that means, so without this, if this doesn't get passed, then bonus depreciation actually started phasing out in 2023. So it used to be 100%, but then in 2023 it was 80%. 2024, this year it's 60%, and then it goes to 40, then 20, then 0 in 2027 or 6. 7, 27. But if this bill passes, retroactive to 2023, 100%, and then pushing off that phase out. So we're all kind of sitting around because that impacts a lot of tax strategies. I mean, Section 469 is essentially all about how do you capture that depreciation, right? Do you qualify as a real estate professional? Do you invest in syndicates and funds? Do you run the short-term rental loophole? Do you buy passive stakes in businesses so that you can create passive losses from your rentals that they offset? Like, there's a whole bunch of planning that kind of starts there. So that's what we're all watching right now is whether or not that's going to get passed.
Yeah, and for those like who don't know what this bonus depreciation is, it is an extremely powerful tool in real estate to basically create phantom losses to offset. If you're a rep, if you have reps, right, or real estate professional status, like you can then write that off against active income, which is like huge. Like for me and my wife, for instance, my wife works a W-2 job, but I'm a real estate professional. I do the logs that you guys make me do every year, and I check all the boxes, right? So then like we get to take rentals and depreciate them, and we would do cost segs on them, even single families, and take that bonus and offset our active, because I flip too, so I get active income from flipping, and then my wife has active income from her W-2 job. So like we can use that, and if you're married, you can do that. So it's kind of cool, and it's a very powerful tool. And syndications, I know, use that to sort of advertise to their potential investors, like, hey, you could get a chunk of this pie, get a chunk of this depreciation. So learn more about that. And especially with there is a collapse happening in commercial real estate, like as we speak, like there's a crash happening in the commercial real estate space. So like if they extend that will help alleviate that crash, because there's so many investors that utilize that bonus depreciation to make a deal or not make a deal,
Yeah.
So
bonus depreciation, just for the audience, is when you buy rental real estate, or equipment for your business, right? You get to deduct the cost of that acquisition. So when I buy real estate, let's say I buy a single family home for $100,000, which I've been using this example for many, many years. I don't think you can. I don't know where you can. Yeah, I don't know where you can get that anymore. Well, let's just assume, just to keep the numbers simple, $1 million. So you buy a single family home for $100K. You have to make an allocation between building and land, because when you buy property like real estate, you are also buying the land in most cases. So on a $100,000 acquisition, I might determine that the land value is $10,000, leaving the building value with $90,000. Now, I was kind of pausing on I determined the land value because it's more complex than just like coming up with a number. But let's just assume I go through the process. $10,000 is land, $90,000 is building. The $90,000 I'm going to depreciate over 27 and a half years. So what is that, like $3,200, $3,300 a year, something like that? So every single year I get to take a $3,300 tax deduction, thanks to the mere fact that I acquired this rental property. So it's just $90K of building value divided by 27 and a half years. It doesn't matter how I acquire it. I could pay cash. I could pay I could put 20% down. I could put 50% down. Doesn't matter. My depreciation calculation is building value divided by 27 and a half. Yep. But what happens is you have something called a cost segregation study. And a cost segregation study is essentially the practice of saying, hey, you bought this property for $100K. $10K went to land. $90K went to the building. But in reality, there's components that make up that building that are not going to last 27 and a half years, right? Things like your carpet, your appliances, your fixtures, like all these things. And so what a cost segregation study does is it identifies all of those components and it assigns a value to it. So we're basically taking away from the $90,000 building, that bucket, if you will, and we're moving some of that value into other depreciation buckets. There's a 5-year bucket, a 7-year bucket, and a 15-year bucket. So after a cost segregation study, you end up with a value that you depreciate over 5 years, 7 years, 15 years, and the remainder is depreciated over 27 and a half years. Now, bonus depreciation, thanks to the 2017 Tax Cuts and Jobs Act, we have 100% bonus depreciation. Interestingly, we've had bonus depreciation for a really long time. So it used to be 50%, but the 2017 Tax Cuts and Jobs Act just made it 100%. But you can immediately 100% bonus depreciate any component with a useful life of less than 20 years. So if I do a cost segregation study and we say, hey, inside of this 90K of building, there's all these components that are going to last 5, 7, and 15 years. We assign value to the 5, 7, 15 years. I can immediately expense whatever that value is, right? Because they're all less than 20 years. So bonus depreciation on like $100,000 single family home, and I'm just going to use random numbers here. Don't hold me to it. You might end up with like an $18,000 first year deduction thanks to the bonus depreciation, right? Whereas if you didn't do this, you would have a $3,300 deduction for the first year. So if you can, to your point, then use that 18K, because that 18K is going to create a tax loss, right? And so if you can use that tax loss to offset your W-2 income or your business income, now you're saving some pretty serious money. And that is where we come in. So we come in and we go, how can you use this tax loss most optimally? Because what happens is, creating the tax loss is simple, but deploying it optimally is challenging, and that requires a whole bunch of things. But you have to understand how Section 469 works, the passive activity loss rules, and if you don't use what I'll call a specialist accountant that understands these rules, you'll end up with this $18,000 tax loss that gets suspended and carried forward. You won't be able to use it in the current year, which isn't like too bad. I know a lot of people fear that. It does give you options later because I could sell a property into that tax loss, but it's suboptimal from a time value of money perspective. If I've got a tax loss today, I want to be able to capture it today and get my tax refund today and redeploy my tax refund today.
Yeah, definitely. Yeah, I mean, that's huge. When I first learned about that, I was like, wow, that's amazing. That's so cool. And one of the points you made about having a good team, we'll get into the next topic here, which is what are the top 3 mistakes investors make on their taxes? Because if you don't cross your T's and dot your I's, you can get yourself in some trouble. So what are kind of some of the big mistakes that investors make on their taxes?
All right. So the first big mistake is not using a specialist. And again, I know that sounds self-serving, and I apologize. You do not have to use my firm, but find a real estate CPA to use. When we see people not using a specialist, the first thing that I will do. So I run our sales at our firm, and my job is to essentially review tax returns for prospective clients and show them all the ways that their prior accountant messed up, so that we can convince them that we're better and that they sign on with us. Yeah, that whole game. The very first thing that I do is I just go look at Form 8582. Form 8582. That's the most important form in your entire tax return. Nobody looks at it. And there's a whole story happening on Form 8582 that if you're not aware of it, it can get out of hand and really cost you some big bucks. So I see a lot of mistakes that get baked into Form 8582, and it's all about your carry forward losses. I've seen carry forward losses just disappear because an accountant or somebody switched accountants, and the new accountant didn't correctly key in the Form 8582 from the last tax return. So one of the biggest mistakes is just not reviewing Form 8582 every single year. So what I try to teach people is every year, once you get your tax returns prepared, if you do nothing else, look up Form 8582. You can Control F on that PDF, the 1,000 pages that you got back from your accountant. You can Control F 8582, go look at that form and just create a spreadsheet that tracks it every single year. Even if you don't know what it's telling you, it doesn't matter. Just go through the exercise anyway, because eventually it'll make sense and it'll prevent you from catastrophic losses of just things disappearing. So make sure that you're doing that, because that's huge. A second mistake that we see is, I don't know why people do this. My assumption is that new investors want to spend a lot of money on entity structuring to make themselves feel sophisticated. But I think it's important to understand that the most sophisticated people and the richest people in our client base use very simple entity structures. Like, don't get me wrong, you always have to cross your T's, dot your I's, and protect yourself from liability, and there are different structures to do that. But man, when we see some people come to us with like a Delaware C corp that they're charging self-management fees, and we see an S corporation holdco for their rental properties. It's like, what are we doing there? Offshore trusts and stuff. It's like, dude, you're going to pay $30,000 a year just for the tax prep. Like, what are we doing? So I try to encourage people to simplify, not from a, I think that simplified entity structures also comes with higher potential risk of litigation or exposure to litigation. But I also think that there's a balance, and just one of the mistakes that we see is people rushing headlong into their entity structuring and just getting a ton of stuff there that they don't really need, and not really understanding the cost. And then the third mistake that I've seen, and this is a big one, is is not getting any planning around the excess business loss limitations. And this is, again, where the specialist kind of comes into play. Okay, so you can go listen to our podcast, the Tax Smart Real Estate Investors podcast. You can Google that. We have like a 6 or 7 series episode on how does the short-term rental loophole work. You can go onto TikTok and see tons of people talking about it. I think they all actually listen to our podcast, and I'm not even kidding, because I'm pretty sure there was the Bradford Tax Institute, which is a great publication. They had written about this one time,
mm-hmm.
and we found it after our podcast because we were trying to figure out, like, did we start this whole like frenzy of short-term? Anyway, I don't think that we did, but regardless, you can go on TikTok, you can go on Instagram, you can learn about the short-term rental loophole and how amazing it is and all this stuff, right? You can learn about real estate professional status, but few people talk about the excess business loss rules because it's not sexy, but it prevents you from taking all those losses to a certain degree. So if you are a W-2 earner, or if your spouse is a W-2 earner and you're going to be a rep, a real estate professional, mm-hmm. or if you are the W-2 earner and you're going to go run the short-term rental loophole, you can only claim up to about like $250K or $500K if you're filing joint of tax losses against mm-hmm. your income. You can't claim more than that due to the excess business loss rules. So the mistake that we see is people, again, just jumping headfirst into executing the strategy to drive tax losses, mm-hmm. but not realizing Section 461L is on the back end of that, and it's going to bite them. So.
Wow, that's crazy. Yeah, that's why you need a smart person to look into that. And you mentioned earlier about having difficulty like finding good people nowadays. There's like a glut of people. It's like, well, Congress just keeps making the tax code even more and more and more complicated, which then...
and look at the timing too. Yeah, what great timing to do this in March.
Right. Yeah, actually, I remember when you, what was it? The same situation was happening with the PPP forgiveness.
Yeah.
You remember my return back then was like on hold for a little bit because you guys were waiting for Congress to rule on, or the IRS to rule on how they were going to handle PPP forgiveness, That
was terrible. And a lot of our clients weren't really like this. So with all of that was just various tax laws coming into play. The whole excess business loss limitation was part of that as well, being pushed instead of being enacted. So there were like definitely some things that were impacting us. But man, I'm in all these like accounting firm communities and stuff, and it pushed a lot of people out of the industry. Like a lot of people just couldn't handle because it required a lot more work on an ongoing basis versus just having a typical tax season and then being done. It was like all year, and it pushed a lot of people out of the industry and just made that supply gap of CPAs even bigger. So yeah, that was really unfortunate. And here we are again deciding retroactive legislation in March, which is great. And there's some talk that it's not going to be done until middle of April. So,
oh my gosh,
I don't know, man.
That's wild. Yeah. So, let's get into the next set of questions here. I mean, there's so much gold in all of this, and if anybody wants to learn more, go check out Brandon's podcast. And if anybody's interested, you spoke to my meetup group years ago and did a whole presentation about real estate professional status. I'll probably share that out with the group. I just remembered that. I've got that saved in my Zoom meetings, so I'll send that out. That was a great presentation. Everybody loved that.
Thanks.
Yeah, man. So let's talk about, obviously, I'm the probate house guy, so I deal with a lot of probate and inheritance topics. That's probably 90% of the deals that we do at my company now is probate and inheritance stuff. And our number one searched question on our website is always tax-related stuff. So from an inheritance tax perspective, there's a couple big topics, and I've talked about them on some of my content that I do. But number one is step up in basis. So can you explain to us what step up in basis is? And this is applicable across a lot of different things, right? But from an inheritance tax perspective, why don't you talk about step up in basis and what that's all about?
Sure. So when you pass away, your heirs get to step their basis up in your assets to fair market value. So let's go back to that $100,000 rental that we used in that example. And let's assume that you've depreciated the vast majority of it. So maybe you've taken over the years $60,000 in depreciation. The property costs you $100K. You've taken $60K in depreciation. Your basis, your adjusted basis, is $40,000. If you sold the property for $90,000, most people would say, "Oh, you bought it for $100, you sold it for $90, you have a loss of $10." Accountants go, "You bought it for $100, you sold it for $90. Your basis, your adjusted basis, thanks to all that depreciation, is $40. So $90, your sales price minus your adjusted basis, is $50K. You have a $50K gain, right?" So that's how this works. But what happens when you pass away is if your heirs inherited this $100,000 property, even though your adjusted basis is $40K, at the time that they inherit it, maybe the property is now worth $300K. They get to claim that their basis is $300K. So they could immediately sell it and get that $300,000 sales price. But because their basis is $300K, they'll pay $0 in tax. So it's very advantageous for people that own assets. And the same thing works in like equities and businesses as well, right? So you get a stepped up basis whenever the parent dies. The heir gets the stepped up basis. Now, here's how you can go back to mistakes. Mistake number 4. Here's how real estate investors blow this up. And we see this, it's way too common. And it's very unfortunate. So I buy the $100,000 property, right? And I want little Joey to have a property for college. This is going to be how I fund that for him. So I just put him on title, and maybe it's me and him. Maybe it's just him, right? Maybe I just swap my name out, which is even worse. But if I put him on title, it's considered a gift, okay? And when you gift somebody something, they inherit your basis in the property. So if I do this and the basis, let's say I do it right when I buy the property, then his basis is $100K. And now we're going to depreciate. So I die one day, the basis is now $40K thanks to all that depreciation. And he goes, "Cool, I can sell it for $300, not pay tax." So he goes and sells it for $300, but because I gifted it to him way long ago, he doesn't get a stepped up basis. He retains that $40,000 of basis. So the key is, related to real estate, be very, very, very careful putting people into your LLC. That's like another thing that we see all the time. Oh yeah, like make your kids a part owner of your LLC. Sure, like you pay your kids, like do all the rigmarole, all the crazy whatever. But like one day, if that LLC ends up owning $20 million of assets, you might have shot yourself in the foot. So you have to be really careful whenever you're putting your kids on any asset that you own in any sort of equity position, because it's probably a gift. And to the extent that you've gifted them property, they inherit your basis in the gift, which will hurt them at some later point.
Yeah, that's a great point there. A lot of people don't realize that. And also one point about that is that the step up in basis occurs as of the date of the death. So like if they wait a year later to sell the asset, they could have a gain in many cases, right?
That's a really good point. And another kind of point to tack onto that too is if you don't wait a year and you sell it immediately, you probably actually have a tax loss.
Yes.
Right? Because you inherit it for $300 and then you sell it for $300, but then you have selling costs, so you probably got a $20K tax loss or so.
Yeah, that's a good point there. I didn't even think about that. See, you're a smart accountant to tell you the right thing about taxes. All right, so another big thing in the inheritance space is the estate tax exemption laws. I got an email, I'm getting notifications. They just upped it. They up it basically every year. So how did those, I know it's a really complicated topic, but in essence, how did those kind of work, right?
Sure. So let's see, where do I want to start with this? Each person has a $13 million estate exemption, meaning that you can pass $13 million to your heir. And if you're married, it's $26 million collectively. So we can pass $13 million or $26 million collectively to our heirs without having to worry about estate tax. Okay. So that's where we start. And that goes up every single year. And I think it's like a little over $13 million right now. So that's indexed for inflation and goes up. And that is going away, though, soon. I think it's 2026. I'm not sure. But it is, or maybe it's 2025. It's going away soon. So it's going to go, not going away, but it's being reduced back to, I think it's 5 million and 10 million combined indexed for inflation. So right now it's 13 million, 26 million. It's going to revert back to 5 and 10 indexed for inflation. And that has been a big hot button topic too, but I haven't been tracking that. So I don't know where legislation is on that. So forgive me. But, what this means is if I died today, I could pass $13 million worth of assets to my heirs without having to worry about paying any sort of estate tax on death. If I had $14 million of assets that I passed to my heirs, $13 million would be excluded. The excess $1 million, I would pay taxes on, and the tax rates graduate pretty fast. So I'd get to that top rate pretty quickly and would owe a lot of tax on that excess of $1 million. Now, what some people try to do is if you're over the $26 million threshold, this is one thing to do. There's a lot of things that you can do, but if you're over the $26 million threshold with you and your spouse, you can start gifting on an annual basis to really anybody, but typically to your heirs or to other family members like nieces, nephews, that type of thing. You can gift up to $18,000 a year. It's $18,000 for 2024, and that is also indexed for inflation. Without having to report on any sort of gift tax form. This is where everybody gets confused. So every single year, like I could gift you, Brad, $18K. Or let's do it the other way. You can gift me $18K if you want to, right?
I think I do almost that every year anyways.
Oh, geez. Yeah, that's
just
true.
kidding. Not that.
Anyway, so I can gift you $18K. And it's not taxable to you, and I don't have to report it. All right, because I have an $18K exclusion, so I can gift it to you. I can gift $18K to my son. I can gift $18K to my daughter. My wife can gift you $18K as well. My wife can gift $18K to my son, $18K to my daughter. So we can gift combined between me and my spouse $36K without having to know all the beneficiaries. They don't pay tax. We don't have to file anything. We don't pay tax. That's fine. Now, if I gift you $20K, I have to report on a gift tax form that I gave $2,000 over the annual limit, right? So the annual limit this year is 18. I gift you 20. I'm 2K over. I now have to file a gift tax form. And when I report that, I don't pay tax on that today. But it reduces my total exemption, that $13 million exemption. It's going to reduce that by $2,000. When that is completely reduced, that's when I pay tax. Does that make sense?
Yeah.
So I could gift you $13 million today and then another $1 million next year. I wouldn't pay tax on the $13 million today, but I would have to report it. It would wipe my estate exemption out. And then if I gifted you another $1 million next year, that's when I would have to then pay tax on that $1 million gift.
Yeah. Awesome. Well, that's cool. That's, obviously we're being very high level with this, right? Yeah. So you should consult your tax professional to get down in the weeds on your specific tax situation so that you don't make any mistakes. But in essence, that's a good explanation of everything. And that's why estate planning is like super important. So from a tax perspective, I mean, tell us about like why you think estate planning, like especially in higher net worth individuals, obviously the average American's never going to probably have $13 million in asset, right? But from any perspective, you can create unnecessary taxable events. So you already mentioned one about putting your kid on the LLC. What are some other like kind of taxable events that people mistakenly create for themselves in this, by poor estate planning?
Yeah, I mean, honestly, it's typically it's related to driving efficiency today, but not realizing how that impacts you later. So, putting kids on the LLC or paying them money today, or how you structure your entities. Like I was mentioning the S corp thing earlier. Let's just it blows everything up, right? So, how you structure the entities that you use and who owns the entities are very critical, not only to tax optimization today, but also that eventual estate planning or really, I guess, you passing away. You need to be cognizant of both, and there's a balance, right? So, but again, the key is to understand when you almost kind of want to do it in tandem, if that makes sense. Like, you kind of want to do a little bit of I don't want to pay much tax today, but I also don't want to shoot myself in the foot. So what should I be aware of? And as long as you stay away from the typical, don't put real estate into an S corporation and be careful about throwing your kids into various equity positions, then in general, I think that you will be. If there's an estate planning person listening to this, they're going to be like, "No, this is bad." But I think in general, if you kind of follow those general rules, you'll be better off than not. That said, I think that not using trusts is a big mistake in estate planning, because trusts aren't really going to help you from a tax perspective. I mean, they can, but you're primarily using trusts to avoid probate. Because if your business and your real estate get locked up in probate, I mean, that becomes very challenging for your heirs to navigate and to keep it running. So that's where we see a lot of estate planning start to go is let's utilize trusts to get to avoid the probate issue when we pass away.
Yeah, and you know what? I'm going to add on to something you just said there. So if you have a business and you have an LLC and you pass away, I have seen this happen to people, and I've made estate planning provisions in my personal scenario to allow my wife to continue to run LLCs in the event of I die. But some people don't do that. And what happens, and I've seen it happen to other people, is their payroll gets stuck. No, the person in charge of the company is dead, and until you probate that, nobody can make any decisions. So I've seen people not get paid. And there's all kinds of crazy things that can happen from an estate planning perspective if you don't make sure you got that done ahead of time.
That's a great point. That's a really good point. Yeah, I think anytime that you're getting into real estate, you need to have a will. You need to talk to an attorney, pay the couple $1,000s just to have a preliminary conversation about estate planning related to the rentals. Should you put it into an LLC? Should they be in a trust? How complex do you need to get today versus later? But make sure you get the foundational stuff down, so that will be really helpful there. Yeah.
Trusts are huge, and people don't utilize them as often as they should. I can tell you, I mean, I've bought, at this point, probably hundreds of probate deals from inheritance stuff, and I can count on one hand the number of times I've bought a property from a trust.
Really?
Out of all of those deals, most people do not do that. But what was cool is when we did encounter that, I was like, sweet. All right, well, you need to show up with the death certificate and you can sign on the dotted line and we're all good. But the rest of the time it's, well, sorry to hate to break it to you, but you're not going to be able to sell mom's house next week. We got to probate this because your aunt didn't file probate 2 years ago and she's got heirs and da-da-da-da-da. And then it becomes this crazy, complicated thing and it's 6 months before we can close.
Man, I never even thought about that. So yeah, on the buy side, it makes it more challenging for you to even buy out of probate.
Yep. Yeah, it prolongs the process and it adds money to the process too.
Right.
I mean, we've had properties where families have gone 2-3 generations without probating things. And then when they go to sell this home that they've been passing down in the family, but not doing it properly, we have to then unwind that whole mess. And so I've filed multiple probates. And I mean, it's crazy the things we've had to do. Unfortunately, on my case, I have a really good real estate attorney on my side, and I have good probate attorneys on my side that can help us get through these, but they're speed bumps, and they inevitably delay the timeline. So I may not get paid on a deal for another, however many months, because now all of a sudden we can't buy it, therefore we can't sell it, therefore, it just delays everything. And then the seller gets pissed because they're like, well, I thought I could sell mom's property tomorrow. And it's like, well, no, you didn't. Or mom had a will, but it was like written on a piece of notebook paper and wasn't witnessed and notarized properly. And it's like, well, mom's will is no good. I'm sorry.
Yeah.
So,
oh, man, that's a nightmare. I didn't even think about that. A really good insight, though. Yeah,
definitely. Well, hey, Brandon, thanks for coming on the podcast today. I really appreciate your time. I always appreciate you've always been super helpful. And if anybody wants to get a hold of you, how can they reach you?
Yeah, no problem, Brad. Thanks for having me. I really appreciate it. It's been fun. You can hit me up at Twitter. So I'm on Twitter now. I've been posting a bunch of like busting the influencer tax loopholes. All the gurus. I've been why the G Wagon thing's not as glammed up as it seems. But anyway, my handle is at bhallcpa.
Okay.
So you can hit me up there. I respond to DMs. You can also hit up our website if you want to learn more about our firm and what we do. It's www.therealestatecpa.com, and you can find our podcast on the website too.
Awesome. Hey man, thanks for joining. And I'll plug you again. Like Brandon's team is fantastic.
Thanks, Brad.
You guys have been doing my taxes and tax prep for many, many years and advisement stuff too. And I, appreciate everything you do, and you've built out a fantastic team over the years. So nothing but good things to say about you guys. So thanks for coming on, man. I appreciate your time. And, if anybody wants to get out to you, they know where to catch you. And I mean, you post stuff all the time out on all the groups. So you're always super, super helpful.
Appreciate it.
All right, man. We'll talk to you later.